Hello, my friends. Brett Pattison here with Iron Gate Global Advisors, coming at you from the financial capital of the West. That is Salt Lake City, Utah, where we are going to answer a very important question. What should investors anticipate as this bull market turns 8 years old? So the three things we're going to discuss today are the three most popular questions that I am receiving from clients. Clients are talking about these more than anything else. And that is, number one, we are going to have a presidential message. People are asking, what is a Trump presidency going to do to the markets? So we're going to reiterate our stance. We've talked about it before. Last week's article was along those same lines, right? What should we anticipate with a new president? So we'll nip that in the bud. And the next thing we're going to discuss is the bull market is now 8 years old. It is the most underappreciated bull market in history, from what I can tell. What should we be thinking and about that, and what should we expect? And I have in parentheses, maybe, right? Because nobody really knows, but we're going to discuss what you can potentially expect. And then, of course, as we round out, we're going to give you three things that you have to do. If you have another advisor, great. It's three things they should be doing. If you're a client of ours, which hopefully you are, these are the three things we're doing. Or if you're managing your own money or trying to, it's the three things you should be doing. So stay tuned for that. All right, let's start with our presidential message. And this is the same information, the same statistics that I shared with a lot of workshops that I taught in November, as well as this same market commentary. And on the left-hand side, you'll see the situation, right? What was the situation? Presidency changing from Republican to Democrat or Democrat to Republican, and then below that you'll see Congress changing from Republican to Democrat or Democrat to Republican. And so it's what happens when we have a switch, right? So that's the situation on the left-hand side. On the right-hand side, you'll see the return for S&P 500 return for the election year and then the inauguration year, which we are in now. And so what happens when we go from Democrat to Republican? It's that second row down, because that's the situation we're in now. You usually see a bump, an average 13.2% return. So you usually see a bump in the markets. And that's simply because Republicans are known as more of a pro-business type party. And so everybody gets excited and the market goes up. And then the following year, though, the market goes down. You can see minus 6.6%. People then begin to realize that we have a checks and balances system, and everything that was promised can't happen. It's harder than they thought. And we're already starting to see that in the Trump world. Flip that. When a presidency's changed from a Republican to Democrat, the election year, the market's down, because they're more of an anti-business type party. Certainly not as pro-business as Republicans. Anti-business, probably strong words. And so the market is down a little bit. Now, for the following year, people realize, those Democrats aren't as bad as we thought for business, and the market goes higher. And so the net result is something we've been telling people over and over and over. History has told us that it doesn't really matter who's president as it relates to the market. Other personal issues, other things that people are passionate about, okay, I get it. It does matter. But as far as the investing goes, it doesn't. And to reiterate this point, I will lean on one of my investing heroes, Sir John Templeton. He put it best when he said the four most dangerous words in investing: this time is different. So if you believe that Donald Trump is just completely nuts, or Donald Trump is going to just be the most amazing president ever, just realize that the four most most dangerous words in investing is "this time is different." So what we need to do is have a plan to attack the markets. And returns are more based on the economic cycle, the business cycle, than it is presidential, right? Who's president? And so what we can do is we can learn from some of the best investors in the world today, and one of those is Buffett. As you know, Warren Buffett was one of Hillary Clinton's big supporters. He was against Trump and said it himself. He campaigned with Hillary Clinton. He lost the election, right, along with Clinton. And so what did he do? Well, this is what he did. He didn't get down in the dumps. He instead bought $12 billion worth of stock. This is what he said to Charlie Rose. He said, we've net bought $12 billion of common stocks since the election. So he didn't worry. He didn't get down in the dumps saying, oh, we got a crazy nut as president. He said, you know what, let's invest. Why? Because there's great assets trading at great prices. Let's put our money to work. And that 9-day stretch before the election and then right after the election, great time to buy stocks, great time to sell puts. We did that for a lot of our clients that had some cash. And it's worked out well, and knock on wood, it continues. So we follow the example of the Warren Buffetts of the world, and we follow our own process, which we'll talk about in a minute. But I will say this, the biggest risk right now is the unknown as it relates to protectionism. That's the biggest risk. This could negatively impact the market. So what are we doing about it? Hold on, I'll tell you exactly what we're doing about that risk here in a minute. But let's talk about the bull market. Happy birthday. It's almost 8. Next month it'll be 8. You can see that over the last 8 years, we're up over a 200% return. And that 07, 08 time frame, even 09, has completely scarred people. The stock market, nobody likes it. Maybe that's changing lately, but people are so scarred because of 07 and 08, they don't realize how great this bull market has been. It's been fantastic. Look at that, 200% return on the S&P 500. Be grateful for that. Be happy for that if you've managed your money appropriately. So the question now is, will that bull market continue? And I'll give you an honest answer, and it may not be what you want to hear, but it's the honest answer for Brian and I in Iron Gate Global Advisors. And if anybody's being honest with themselves, it's the honest answer for everybody. And that is, we have no idea whether this bull market is going to continue. No idea. Nobody has any idea. I'd be lying if I said, you know what, the stock market's going to do this. The fact is we have no idea. But I would say here is what we're watching. We're watching two things, and this is how we gauge the bull market. First, we take a look at history. And I'll show you history in a second. But the second thing we'll look at, which we'll talk about now, is the current mood of investors. And I'm going to bring up one of my investing heroes again, Sir John Templeton again. And he said this, and this quote may look familiar to some of you because it's something we rely on. And he says, bull markets are born on pessimism, which is what happened in March of 2009. They grow on skepticism, which is what has been happening. They mature on optimism, which is where we are now. People are beginning to be optimistic about the market. They're seeing 401k balances higher. They're seeing, their own investment accounts higher, and so they're becoming a little bit more optimistic. That's where we are. But the market dies on euphoria, as Sir John Templeton points out. And think of euphoria as the tech bubble in the 90s. Think of euphoria as the housing bubble as most recently. Everybody was getting rich on housing, building spec homes. It was crazy. That's euphoria. We're not there yet. So the current mood of investors, optimistic, that's not a bad thing. That's a good thing. That's where we find ourselves now. So let's take a look at history. What should we expect? in history. And we take a look at history just to help give us an idea of what to expect, although again, nobody knows for certain. So, a couple things to note. The last 1/3 in the history of bull markets, the last 1/3 of a bull market typically produces 50% of the return. That is likely where we are now, that last 1/3. We're in that optimistic state. We have yet to hit euphoria, but we're in the optimism, call it stage. And this is, I believe this is where we are. I hope this is where we are. Again, nobody knows for certain, but that's where we see great returns. If you figure that 50% of the returns comes in the last third, hey, it's been a good bull market so far. Let's hope that's the case. The other thing is the average S&P 500 bull market annual return is about 19%. So if you take a look at the bull markets, this is not including bear markets, this is just the average annual return of the S&P, and during a bull market, that's 19%. We have not had that the last 3 years. 2013 we were above that. 14, 15, 16, we were below that, which tells you that we've kind of had that pause, that bull market pause, which is that second third. Now we're in potentially the last third, which is where those market returns come from. So we're optimistic that this is going to be a good year. Again, nobody knows for certain, and I'll tell you exactly what you need to do because of that here in just a second. But the last thing is when we hit that euphoric state. Greenspan gave a famous speech where he said, "We are in a state of irrational exuberance, euphoria," in the words of Sir John Templeton. When he gave that speech, the bull market lasted another 39 months. So we don't know how long it'll last. We don't know, even when we hit that euphoric state, how long it'll last. So with that in mind, what should you do? 3 things I want everybody to be thinking about, and it's those 3 things are what we are thinking about every day. The first thing is you got to understand the risk in your portfolio. Clients at Iron Gate Global Advisors, they have a risk number. They know that portfolio has a risk of 75 and that there's a 95% probability in the next 6 months it could be down 16% or up 25%. And so they can prepare themselves psychologically saying, you know what? Can I handle risk if the market goes down? Can I handle losing 16.6%? Right? That's the question that they can answer. And if they can't, we reduce risk. And if they can and can accept more risk, then we increase the risk in their portfolio. Very, very simple. If you don't know the risk in your portfolio, then you're missing a huge, there's a huge gap in your analysis and in your understanding. The other thing that you need to do is stay the course by following the process. I'm not going to go into our process. I wrote about it last week. Check our blog. You'll understand more of what we mean. We're process-oriented. We're not results-driven. We're process-driven. Follow the process. The results will come as they have. The last thing that I want you to do is think long-term, not short-term. People, this is the hardest thing for people. They'll have a 6-month time, a 1-year time, for even 2 years, to where the market doesn't treat them the way they want to be treated. And so they freak out and they do something dumb. We're not investing for 2 years. We're investing for 5, 10, 15, 20, 30, 40, 50 years. That should be the thinking. And we help clients think that way through some of the technology that we have. And so if that's a fear of yours, or if you're having a hard time with that, you got to reach out. You got to contact us. We'll help you get over that short-term thinking trap that destroys a lot of investors. With that, my friends, relax. We can take it from here. I hope you learned something new about where we are, presidential message, the bull market, and those things that you can expect potentially, and those 3 things that you should be doing in your portfolio. If you have any questions, feel free to reach out. There's our contact information. Be more than happy to answer any questions, run through portfolio reviews, or anything else. Thanks for joining us. We'll catch you next month.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.